And welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. This is the show where we bring you where the action is in the broader markets. And I hope you had your seatbelts on last week. It was quite an eventful week. I'm going to share with you what we are going to be taking a look at here today. As usual, we're going to take a look at the broader markets and see where did we close the week relative to what we can be on the lookout for. From there, we will look behind the markets and look for sector rotation potentially and industry group movement. Top headlines that did hit the news this week and pushed stocks around. I will share that with you. And then also earnings season has begun in the sense that we've seen some larger cap, mega cap names reveal their results for the third quarter. We'll get into that as it relates to how the markets are responding. And then also, where do we head from here? I'll share some insights there as well, basically trying to make sense of a rather tumultuous week. And as always, I do want to urge you to use that link below for a special trial offer of my twice weekly MEM Edge report, because that report will provide you with a lot more in the way of insight and actual decision points that we need to be on the lookout for with these broader markets. So let's move right in, take a look at those headline news. First up, earlier in the week, we did see Producer Price Index. You may know it as the PPI, and it did come out showing that inflation is still quite high for September. Not great news, as the Federal Reserve is continually announcing their intent to keep interest rates high to combat inflation. And in fact, my next bullet point here talks about that. Federal Reserve officials, last week we had about 14 federal officials, or certainly not individual, but 14 appearances by these officials. The prior week, it was closer to 20. And then this week as well, they are continuing to lay out their campaign and intent to remain aggressive in that rate hike cycle in order to fight inflation. We did see in news earlier, certainly on Monday, relating to semiconductors, with Biden continuing to initiate new chip sale restrictions to China. And that's just one reason that semiconductors were especially hit hard last week. Later in the week on Thursday, all eyes on that CPI, and that's in particular the core consumer price index. And it did come in well ahead of estimates, that core number. But despite that, those of you that follow the markets very closely may have noticed that we pre-market and into the open, the markets were down about 2%. That was regained and then some. We'll get into that as we move forward. Today, retail sales came in. They were flat. Consumer confidence rose a bit. So not a lot in the way there as it relates to impactful for the markets. Consumers remain okay, despite high inflation, high gas and food costs that came out in that core, that CPI number earlier in the week. So let's go ahead and move over. We're going to take a look at the broader markets and see where did we close for the week. Here we are with the daily chart of the S&P 500. A couple of things to point out to you on these momentum indicators here. The RSI remains below that 50, trending lower, not good momentum. And then the faster moving stochastics, another momentum indicator, down here in negative territory. So our momentum indicators are negative. And then looking at the close of the markets for the week, we can see that we did hit, we closed above a new low that was encountered at the open on Thursday. And we did find upside resistance at this 21-day simple moving average. That seems to be a very standard bear market rally area of resistance. Net, the markets remain in a downtrend in a bear market environment. From here, let's take a quick look at a longer view. You are going to need to zoom out and take a look at where we did close the week relative to support, which would take us back to the fall 2020 period. I'll get more into that in my weekly report as it relates to the possible descent to that area or not, what to be on the lookout for. So I did want to share with you an intraday day chart of the S&P 500, 15-minute, not normally a go-to for me, but in this market, it is very, very helpful. I do a live trading room over at Simpler Trading, and last week I had the opportunity for 3 different periods, 3 different days, to talk about the markets and what was taking shape. And this 15-minute chart was really instrumental as far as really trying to make sense of these broader markets. I do have a 5 and a 13 simple moving average and those same momentum indicators here. So what we are looking at as it relates to price action this week, we did have this deterioration throughout the week with a multi-hour rally here on Tuesday. But let's take a look at the price action on Thursday. Actually, we can see this big gap down that took place with that very high CPI inflationary metric being released. And as that took shape and we came into the next few 15-minute, within that first hour, buyers came in. Now, there's a lot of speculation relating to the fact that were so many people on the lookout for a weak CPI number simply because the producer price index was negative and there is a very high correlation. So the sense is that there were an awful lot of people that were short going into this number, or certainly negative. And when the markets, we did see buyers again coming in, covering those shorts, because pre-market it dropped, but then buyers came in, which in turn escalated further buying for potential short covering. There were other reasons as well, but that's being viewed as the overarching reason that we did get that highly unusual spike. But again, when you're looking at these shorter term charts, and this is going to be, I'm going to share with you individual stocks as well, you're going to want to pay attention to the price movement relative to these moving averages, 5 and 13, volume characteristics. We did have volume on that buying into the open on Thursday, and then metrics relative to momentum as we got into this oversold position and the momentum begins to shift higher. This is going to be mostly for intraday traders, but in my trading rooms, I did highlight for those that were participating on Thursday what to be on the lookout for to indicate further deterioration. Quite simply, a break below these MAVs and negative momentum, which is what took shape today in the first 30 minutes. So super near-term view, but this can be helpful again for individual stocks as well. So let's move on, take a look at the S&P 500 sectors last week, their performance, and what is taking shape. So I've gone ahead with this 2-month daily price chart view. I've added an RSI, that's a relative strength indicator, sorted the list descending order. So we want to see relative strength, and certainly doesn't mean that they were up necessarily for the week, but maybe they were down less than the broader markets, but they are showing again that relative strength. And down here, your weaker sectors in this lower right-hand quartile. So first up, we can see energy, and the energy group for the week was down. Let's go ahead and pull up the weekly so I can confirm it was, yes, down 1.8% for the week. However, we did see exhibited a nice rally here, pull back to that 10-day simple moving average. A lot of this having to do with the price of oil, as well as OPEC dynamics, where they have decided to reduce output. We'll go ahead and, as we move forward, share certainly at least the price of oil. Healthcare, very interesting. It was up about 1% for the week, not a particularly constructive chart, but again, it's all relative. We are seeing buying in select areas of healthcare, and this aligns with areas that can perform even in a bear market or recessionary period. I'll share those dynamics with you as we move forward. And then financials did get a boost. They were down, but less than the broader markets. I'll share with you what took shape here as well. A lot of it having to do with earnings season and some of the areas that are picking up. Let's go ahead down to these weaker areas. Super critical that you're aware of them, because among areas that are getting hit are, for instance, utility stocks, super beaten down. And from what I can imagine, investors are at some point anticipating a bounce given this very large deterioration that we've seen here. However, not quite ready for prime time. We can see any rally attempts being met with upside resistance at this 10-day simple moving average. Rallies that have had more in the way of legs have broken up above resistance. Certainly, we can go back to this August period. A lot of these companies coming out with strong numbers. They've been able to pass increased cost on to consumers. But in this instance, we have a couple of dynamics, headwinds, in the sense that the utility stock yields are not being viewed as favorably in the face of a big uptick in treasuries. And then also the fact that utility companies do require a lot in the way of capital to keep their operations updated. And with interest rates rising, their lending costs are steep. So that is pushing that area downward. Let's take a look at another area, real estate, REIT stocks, another really beaten down area of the markets, very oversold. Similar dynamics as it relates to capital and fundraising headwinds. And then also talk of a recession is not good for companies that are renting out apartments or commercial space to businesses. So those are the highlights relative to the sectors. I just want to make sure I'm not missing anything. Consumer staples was the best performer, and I do want to share this with you. It was up 1.8%. Although let me just double check on that because I can see it. So up 1.6%, and we can see that it is in the potential throes of beginning to reverse this downtrend, but we are going to need to see it break above that 21-day. I'm going to share with you a couple of names there. I did write an article with StockCharts right here that you can go ahead and access earlier this week, all about Pepsi and their earnings and what to be on the lookout for, because areas that did somewhat outperform earnings were a driver there as well. So I'm going to move forward from here. We're going to take a look at several ETFs, actually 12 ETFs, that are really quite useful very powerful actually in helping you understand what is driving current price action in the markets. So again, that 2-month daily price chart view, the RSI in descending order. So up here, your relatively strong areas, and they're not all ETFs. For instance, we are looking at the actual yield on the 10-year treasury, and it hit 4% this week. It closed at 4%, and that is a super high level. If you consider that you can purchase a treasury bond for 4%, certainly relative to a utility or some of these other interest-bearing, the average yield for the S&P 500 is 1.6%. So not only certainly here, but there is a lot of interest overseas in capturing that high yield in a very uncertain stock market environment. Here we are with the US dollar, UUP, and you can see that it is pretty flat for the week, but definitely on the rise, not good for the markets, and another indication of foreign buying of these treasuries. Volatility up here also on the rise as well. Interestingly, not as responsive as you would anticipate given this week's volatility. This is also in the broader markets. This is also known as the fear index. It is still generally rising. Momentum indicators positive, and that is a negative for the broader markets. Similar to, let's go ahead and take a look at Brent crude. We did see a spike on Monday, a pullback, and then an increase again today. This is a daily price chart, but at the end, we did close the week at about that 94, 95 level. This 100 level on the per barrel pricing of crude oil has been really impactful in the past as it relates to energy stocks. We did talk about the group being down for the week, but there were some bright spots. Subscribers to my MEM Edge report will be aware of that. We've been treading into some of these areas. So let's take a look at biotechs. This is another area that was positive, up about 1%, while the S&P 500 was down about 1.2. And I'm going to share with you some of the names here. And again, this is another area that aligns with areas that can perform well despite a difficult market environment, despite recessionary possibilities, simply because if the company is providing a drug or something that can help with a particular disease, the demand will still be there for that product despite otherwise downward trending market. Let's go ahead and move down here to this lower quartile. I did mention to you that semiconductors got hit earlier in the week. They did experience a bit of a rally in line with yesterday's anomaly and gave most of that back today, so that semiconductor stocks were one of the worst performing sub-industry groupings, down almost 8%. Lots of dynamics. I talk a lot about this area in my MEM Edge report relative to why they are experiencing selling pressure and what to be on the lookout for going forward. And the reason for that is quite simply semiconductors, when they get going, this is a monthly price chart, they can really provide supersized outperformance. So it is going to be of interest from my work because my focus is uncovering stocks, especially in a nice bull market, that are poised to outpace the broader markets. Another area getting hit here is software. This particular group was down as well. And again, all about the rise in yields not being favorable for growth stocks. The group was down about 5.2%. So from here, let's go ahead. I did want to, there are any number of ways I could go from here, but I did want to share with you that the Dow Jones Industrial Index was up 1.3%. So from here, I'm just going to take us over to, again, that 2-month daily price chart view of the underlying 30 stocks in the Dow, and take a look at some of the names that are driving the Dow to be positive for the week. We can see Merck. This is in line, I mentioned to you, with medical healthcare stocks, companies that are coming out with innovative products that are outpacing the broader markets. Take a look at that gap up on Merck, aiming toward a base breakout, not what we're seeing elsewhere in the markets, but aligns with that positive movement in healthcare group. From here, we can see energy stocks, Exxon, a big holding here with the Dow, holding up really remarkably well, certainly relative to other areas of the market. And then travelers, we're seeing some insurance stocks attempting to turn, not particularly constructive there, but Chevron, another energy name. And then we can take a look from here at JP Morgan. And this is among several of the larger Wall Street bank stocks that reported their earnings today, and the stock is up almost 2% on the day, but we can see that that move above that 50-day simple moving average earlier today fizzled. We're back down below resistance, and this is what we've seen with a number of names, certainly bank related, that came out with strong numbers, rallied above resistance, but then fizzled into the close. Now, Wells Fargo is an exception. They came out with numbers today, and they've been able to retain a presence up above that 50. Momentum is constructive here. However, we just have to consider the broader markets and not really anticipate a lot more in the way of upside. We're going to be meeting resistance here at this 200-day simple moving average at about 46. But among those bank stocks, WFC did hold in probably one of the best among those larger bank stocks. So we do want to be aware, of course, of the weaker areas in any index. And here we are with the Dow. I'm just taking us down to these weaker components, and we can see Microsoft down again. It was down about 2% today, really struggling. I'm going to share another view of those FANG stocks with you because we would need to see these mega cap growth names get up off the mat before we can anticipate a really prolonged rally. We can see Apple down here exhibiting very weak characteristics. So from here, I do want to share with you another chart of an intraday, and this is going to be for those of you that might be inclined toward being more active in your trading activity. This is a stock that throughout when I am doing these live trading rooms, it comes up not because it's super well known, but because of its trading dynamics. This is TWNK TWNK, and we can see that it is somewhat volatile, but really useful on this 15-minute chart. If you, again, are someone who is a bit faster in your trading, you can use this 15-minute chart to get you into the stock as it breaks above these shorter term moving averages. Exit, again, not really, not my cup of tea, but definitely worth sharing as it relates to using those momentum indicators and moving averages to guide you. If we can get this T, and this is certainly not relative only to this stock, this is educational, as other names are exhibiting similar price action where they pull back with the markets. This particular name among consumer staples has held in well, offers a nice yield. I'm just going to segue right into some other consumer staple stocks, because in addition to offering a nice yield, these particular focused companies are seeing, this is a daily price chart, and you can see it's very much a different view than what we've seen in the broader markets. Quite simply, brand loyalty. So I will take us right over to PEP and share with you what that chart is doing and did this week. This is a company that came out with earnings on Wednesday, and big gap up. It gapped up 4% on the day and then had a 2.5% continuation rally the following day, gave up a good part of that today. But the bottom line is these consumer staple companies that have been able to grow despite increasing their prices. Pepsi, a lot of their products, they increased pricing by 17%, but they did not see pushback. Again, we are consumers. We want our Twinkies. We want our Frito-Lay. But at the end of the day, it is all about growth. So we can see with PEP how it has broken back above each of these moving averages, and then your momentum indicators entering positive territory. But as with any name, you will have to certainly have a good understanding that you are going against the tide, given the broader markets. But we've seen periods where these staples stocks can outperform. And so among that, I am going to share with you a couple of other staples stocks that are holding in relatively well. And then from there, we'll journey over to healthcare. And quite simply, because these are areas that have historically can withstand downward pressures in the markets, given the way that they are structured and their yield and so forth. So here we are with TR. This is Tootsie Roll, and you can see a similar downtrend reversal taking shape. Not so much on the way of volume, but your outside momentum indicators heading upward. What we can do with StockCharts.com from here is go ahead and ask for a full quote, and it will provide you with that yield information. Looks like about 1% for this particular company. I'll share with you just a couple more names from here. Good old Campbell's Soup, CPB is the ticker. This particular company, 1.5% yield, but similar dynamics where it's able to withstand downward pressures, break above these moving averages with now bullish momentum indicators here. And then I believe really that's about it relative. Actually, one last name that has dynamics very focused to this particular company. This is Calm Foods, CALM, one of the largest producer of egg products, and we can see where it is poised to break out of a base and RSI above 50, trending higher, and then likewise that MACD just now having that black line up through the red, that nice crossover. From here, I'm going to share a couple of biotech stocks. These are going to be companies that have either been upgraded lately or have new product developments. First up here is AMGN. So take a look at this gap up that took place on Tuesday, now above these moving averages, your outside momentum indicators constructive. This is all about an upgrade from Morgan Stanley. The company has several vibrant products, obesity related and otherwise, in their portfolio where growth is expected to continue. The stock is now poised to break out of a 5-month base. So not what we're seeing elsewhere in the markets. From here, I'll share with you Gilead, another heavyweight biotech stock that is exhibiting constructive characteristics here. And this particular company, I'm not sure how I lost that, but I'm going to go ahead back to this full quote and share with you that they offer a 4.4% yield. So similar to a nice product mix, having that nice yield. And then last up, we can take a look at Biogen. This is another company that had positive news here going back about 2 weeks ago. Big gap up, really able to retain that gap up despite an otherwise difficult market environment. And then the stock is now broken back above that 10-day simple moving average. So really highlighting some bright spots in an otherwise dire period. From here, I was going to share just a couple of these inverse funds, and we can know what to be on the lookout for. This is ProShares Ultra Short QQQ, and you can see on yesterday's rally how it really dropped, of course, and then today regained quite a bit of that. Inverse ETFs is an area that I do cover in my MEM Edge report. We had an ETF that had an incredible week. We put on the semiconductor inverse 2 times last week that's helping us out, and there will be others as well. So again, use that button below to take a 4-week trial at a very nominal fee. I'm going to leave it there, everyone. I hope you have a wonderful weekend, and I'm going to look for you again next Friday.